Picture this. You're at the edge of your seat, heart racing as the world's most powerful financial institution is about to make a decision that could change your life. Will your mortgage payments skyrocket? Could your investments soar or plummet? The tension is palpable as the Federal Reserve announces its latest interest rate decision. This isn't just another boring financial update. It's a pivotal moment that could reshape economies across the globe. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. The Federal Reserve's interest rate decisions are like the heartbeat of the financial world, pulsing through every corner of the economy. From the bustling streets of New York to the quiet suburbs of Sydney, these decisions ripple across borders, affecting everything from your monthly car payment to the value of your retirement portfolio. But why does a U.S. institution wield such immense power over global markets? It all comes down to the interconnected nature of our modern economy, where trade, capital flows, and currency exchange rates tie nations together in a complex financial web. At the center of this web is the federal funds rate, the benchmark interest rate at which banks lend money to each other overnight. It's not just some arbitrary number. It's the cornerstone of U.S. monetary policy, carefully calibrated to regulate economic activity. The Federal Open Market Committee, or FOMC, meets regularly to set this rate, poring over mountains of economic data to strike the perfect balance between growth and inflation control. Even a tiny adjustment to this rate can send shockwaves through the entire financial system. So how exactly do these rate changes work their magic? Imagine the economy as a giant machine, with the federal funds rate as the master control lever. When the Fed pulls this lever up, raising rates, it's like throwing cold water on a simmering pot. Borrowing becomes more expensive for both consumers and businesses, putting the brakes on spending and investment. This cooling effect helps keep inflation in check. On the flip side, when the Fed pushes the lever down, lowering rates, it's like adding fuel to the economic fire. Cheaper borrowing costs encourage spending and investment, stimulating growth and potentially creating jobs. These rate adjustments do and just exist in some abstract financial realm. They have real-world impacts that touch every aspect of our lives. When rates go up, that dream home you've been eyeing might suddenly slip out of reach as mortgage payments become more expensive. Businesses might think twice about expanding or hiring new employees, potentially slowing job growth. But it's not all doom and gloom. Higher rates can also mean better returns on your savings accounts. Conversely, when rates drop, you might find yourself with extra cash in your pocket as your monthly payments decrease, spurring you to spend more and boost the economy. The stock market is particularly sensitive to these interest rate shifts, often reacting with lightning speed to Fed announcements. Higher rates can spook investors, leading to sell-offs in growth stocks, as the cost of borrowing rises and future earnings look less attractive. Meanwhile, sectors like banking might see a boost as higher interest margins fatten their bottom lines. When rates fall, we often see the opposite effect. Growth stocks soar as investors chase higher returns in a low-yield environment. Just look at the market rallies that have followed surprise rate cuts in the past. These moments of financial history show just how powerful the Fed's influence can be. But the Fed's reach extends far beyond us shores. As the issuer of the world's reserve currency, its decisions can cause seismic shifts in global exchange rates. A rate hike might strengthen the U.S. dollar, making American goods more expensive abroad and potentially hurting exports. This ripple effect touches economies from Canada to Australia to the UK. As global investors reshuffle their portfolios in response to changing U.S. monetary policy, it's a delicate dance of international finance, where a step in one direction can lead to a complex choreography of global market movements. So how can savvy investors navigate these choppy waters? The key is to stay nimble and adapt your strategy to the changing tide of interest rates. In a higher rate environment, you might want to consider defensive sectors, value stocks, and fixed income assets like bonds. These tend to offer more stability and consistent returns when borrowing costs are high. But when rates are low and the economy is heating up, growth stocks and more aggressive investments might be the way to go. The golden rule: always balance risk and return, and never put all your eggs in one basket. As we wrap up our journey through the fascinating world of Federal Reserve interest rates, let's recap the key takeaways. The Fed's decisions are not just dry financial news. They are a central driver of both economic health and market performance. With effects that reach far beyond U.S. borders, smart investors understand this power and adapt their strategies accordingly, riding the waves of monetary policy to potentially boost their returns. But the learning doesn't stop here. The world of finance is always evolving, and staying informed is your best defense against uncertainty.
Yes.
So, what do you think about the Fed's latest moves? How have interest rates affected your personal finances? Share your thoughts in the comments below, and don't forget to hit that subscribe button for more insights from the Savvy Finance Corner. Remember, in the world of money, knowledge truly is power. Until next time, keep growing your wealth and stay savvy.